Okay, thank you very much. I've got a similar challenge, 19 slides, so let's get going. These are the broad points that I'm going to make. We've seen a transformation of the role of regulators since the 90s under various pressures, shift to DC, risk-based supervision, accounting standards, and market turbulence, many of which already mentioned. This is supposed to be on. Stop the clock, stop the clock. This is my, I mustn't lose time. There you go. Okay, I'm on now.
That was 22 seconds.
Thank you very much. But you heard what I said anyway. And there are some outstanding issues I'd like to highlight. We've already mentioned longevity risk. I think pro-cyclicality I hope I'll get to as well. We all know why to regulate pension funds, so I'm going to leave that one. So let's move on. Investment regulations. We've seen a shift from quantitative asset restrictions to prudent person in a variety of countries, especially the EU and Japan, of course. And this has itself involved a change in the approach of regulators, assessing the validity of the approach to investment and not the assets themselves. It needs transparency, and there are various different ways we find of applying prudent person. So that is a first important shift in the role of regulators. That applies to both DB and DC. If we move on to focus on DB, key point is that given the investment rules, traditional focus of DB funds is funding of benefits and ownership of surpluses. And a key background point is that the fund is conceptualized differently in the Anglo-Saxon and continental countries, and we need to think about that when we evaluate regulation. Much more focus on the sponsor backup and the guarantee fund in the Anglo-Saxon countries. In continental Europe, more that the fund is an insurance company and the sponsor is a reinsurer. The pension storms have been a key background to the evolution of regulation, especially risk-based regulation, on which I will now focus. So as we move to consider the key point, I think, is this move to risk-based regulation, whereby risk management we can define broadly as starting from a strategic level, looking at the risk factors, moving down to the appropriate level of risk, and then controlling it. We've already heard that for longevity risk. The DB funds, of course, bear risks, which are inflation, market risk, and as we've heard, longevity risk as well. And a traditional focus was just on the assets. The large funds started to move to asset liability, and that best practice has, if you like, been taken on by the regulators. Risk-based regulation has been taken on partly due to the financial market shocks. It helps the funds assess the complex markets, and it ensures supervisory resources are well used. It's also been influenced by the integration of supervision, whereby national overall supervisors have taken over from specialist pension supervisors. And the preference then has been to try to make more similar the regulation of banks, insurance companies, and pension funds. And a key focus of this shift has been a focus on corporate governance of pension funds and on management, as I say, rather than assets per se. Components of risk-based regulation has been, in particular, use of asset and liability management. For example, in the Netherlands, where I would appear to be mandatory, it would have been great if we'd had a Dutch person here who would have had a lot more to say, perhaps, on that. An issue, of course, with imposing these sorts of rules is that you may end up with herding, you may get model risk. Sometimes value at risk has been imposed as well, which imposes a short time horizon. Stress testing has been key. For example, in the Netherlands, funds have to have only a 2.5% probability of falling below 100% funding within a year. But how realistic are those scenarios? That's always the problem with stress testing. Risk scoring, which will affect the rigor of supervision. Tightening of solvency regulation to accompany that regulation, the risk-based regulation. And the national approaches have differed quite considerably. The Dutch, for example, have a model-based approach very similar to banking. And the key issue here to me is that are we introducing sort of uncritically a formulation of regulation which is based on banking and Basel and fairly short time horizons on an inappropriate sector, namely pension funds, and that's something people may want to discuss. Development of guarantees, surprisingly, given all the bad press that ERISA's had from US financial economists, we've introduced one in the UK as well, with scheme-based and risk-based levies. And there is an interesting point there that we get an extra pension regulator as a consequence of this. So there's a danger, and this is an international issue, I think, that if you get multiple regulators with multiple targets, then you end up with possible overlap and underlap. The guaranteed regulator in the UK is worried about wind down as opposed to ongoing pension provision. Accounting standards has been mentioned already. It's a form of regulation, if you like, because it's market discipline. And as has been argued, mark-to-market fair value accounting maybe shifts the focus to interest rate risk, hence our discussions earlier on different approaches to liability-driven management. And thus, one can argue, the accounting standards have shortened the time horizons and may limit the investment in illiquid assets. They may be inconsistent with actuarial approaches, and as I say, end with a focus on liability-driven investment, which is costly. On the other hand, the only funds that survived the subprime were the ones who actually were immunized, like the UK Boots pension fund and my own Bank of England pension fund, incidentally. As well as regulators' market-based calculation of liabilities, the focus on wind-up liabilities. Let me move on then to defined contribution funds. Of course, the regulation of DB has itself helped to further the shift to DC. The burden of regulation has been an aspect of the move to DC. It hasn't been the only one, but it's been very important. We've seen the vulnerability of DC funds to market turbulence, although it's less focused on, because it's the retirees who are going to be hit in the end. And a focus on investment risks, as well as costs, annuitization, and education in the development of regulation of DC. Looking first then at regulation of costs. We seem to have a thunderstorm somewhere. I don't think it's me. I'm losing more precious seconds here. Is it sabotage? Yeah, a variety of costs for DC plans, and the point that I want to make here very briefly is that we can see in recent regulation 4 different options, if you like, for controlling costs. Firstly, direct regulation, and fourthly, transparent. I think that she may be merciful as a consequence, or at least I hope so. And fourthly, transparency. And the question there is, well, there may be transparency, but do the beneficiaries really understand? I now have 3 things to hold and 2 hands, but I'll manage. Regulation of risk and outcomes in, I should have it in my head, you see, this is the problem. Regulation of risk and outcomes of DC funds. We've seen that most mandatory DC funds are retaining their QAR, quite interestingly, even though there's been this general shift to PPR, prudent person rules. In some countries, minimum return regulations have been maintained, as in Switzerland. And here's an interesting point to my mind, that risk-based regulation has been extended to defined contribution funds in a number of countries, like Denmark, Australia, and Mexico, and including stress testing, also VAR ceilings, as in Mexico, how volatile will you allow the fund to be, risk scoring, comparison to best practice. And the question here is, well, is this really appropriate to have risk-based regulation of that nature? Shouldn't it be focused perhaps more on the possibility that you're going to achieve an income replacement target rather than short-term risk in defined contribution funds? And a final point is that default options are being focused on more than they were, although I understand not so much in the US. And that's an important issue. What is the default option, since most people choose the default option in a DC plan? It should be very carefully designed and focused upon, and isn't always the case. Annuitization, I think we're going to leave. Transparency and education. Transparency has a role, as we've heard, as a market discipline. It's also, the auditors have an important role reporting on risk management to the supervisors, for example, in Australia. The question that arises here is, if the supervisors have a risk rating, should they disclose it to the market? In Chile, they have pension risk simulators for consumers, but surveys still suggest in countries where there's a great deal of information that there's still poor knowledge. There needs to be wider pension education. It's often stated. One point is maybe at school you try and teach people about pensions, but if they're not in the situation of paying, they may not listen. So it's a question, what point do you get them involved in pension education? I'm winding up now. Looking at the evolution of portfolios against the background of all those regulatory shifts, we have seen a decline of equity holdings for DB and DC funds quite widely, which I think is partly due to the accounting rules and risk-based supervision, although the risk balance may not have shifted as much as one would judge straight away by looking at equities due to unconventional instruments being used. And of course, market experience has been part of that as well. Look, finally, at a couple of weaknesses. Firstly, as we've heard already, longevity risk. That there is a challenge here for both DB and DC plans. One scary thing I read, which may or may not still be true, you'll have to tell me, is that in the US, people might still use the 1983 table of mortality. In Switzerland, apparently, funds can choose their own mortality tables. So that's a regulatory area where there's a lot of gaps, which would warrant closer attention, I think. And of course, low interest rates intensify the impact of a rise in longevity. The Dutch are looking at risk sharing as a solution to longevity risk, where retirement age and benefits can be flexible. Pro-cyclicality is something that hasn't been mentioned yet, and I think is very worth focusing on in relation to the stock market crisis, etc. That this may be the pro-cyclical behavior of pension funds may be intensified by risk-based regulation and fair value accounting, whereby there's not enough surplus in the upturn, there are fire sales selling into an illiquid market at very poor prices in the downturn, and then heavy funding needs that affect fixed investment. And pension funds, it would seem, have become a lot more like banks in their behavior, which wasn't the case in the past. Regulatory forbearance, of course, was a response to the crisis, and that helped to mitigate these factors. The question is whether something more long-term needs to be done in order to prevent further pro-cyclicality. For example, flexible tax ceilings, allowing a greater surplus to be built up in the boom. Smooth discount and solvency rates. We seem to be going the opposite way towards very precise and short-term ones. And lesser reliance on contributions on current market values. So to conclude, we've seen widespread innovations in our pension regulation and a greater focus on risk and on transparency and governance. I'm arguing that longevity, pro-cyclicality, and education are the big areas where further work is needed, as well as short-term investment. And I just thought I'd conclude by saying, do pensions need a Basel III? Those of you interested in financial regulation will know this is the massive work that's been done, this is my last slide, on banking regulation, and it's built a veritable cathedral of regulation. And we need to think, as I say, whether pensions are being pushed into a banking-type regulation already. Well, here's some thoughts. Global agreements are not needed in pensions. National rules, and there's no cross-border competition, although I think the multinationals would very much like a more cross-border comparable regulation. Solvency is core, so that's comparable to Basel III. The design may be counterproductive. Liquidity less important due to long-term liabilities, except for the most mature funds. Maybe some more thought at an international level on offsetting pro-cyclicality. We are investing in global markets. And finally, thought on macroprudential regulation. We do have a friend here from the IMF who are looking very much at how pension funds may impact on the financial system. They are so large, especially if they grew to our 235% we heard over here, that they would have an elephantine effect on financial markets even more than they do now. So that's something worth thinking about. Thank you very much.